You're working from a beach cafe in Bali, your laptop open, your coffee fresh, and your bank account getting paid by clients in 3 different countries. Life is good. But then tax season arrives, and suddenly you have absolutely no idea what you owe, to whom, or whether you're accidentally breaking laws in multiple countries at the same time. That feeling of panic is exactly why we need to talk about this today. Here's a thought. The IRS doesn't care that your office had an ocean view. Last year, a freelance developer paid taxes twice on the same $60,000, once to Thailand, once to his home country, because nobody told him that staying 184 days somewhere has legal consequences. Digital nomad taxes are genuinely one of the most confusing and most ignored topics in the entire remote work conversation. Everyone wants to talk about the freedom, the flexible hours, the exotic locations. Very few people want to sit down and figure out what local tax obligations actually mean when you're constantly moving. But here is the truth that nobody tells you when you buy your first travel backpack and fire up your freelancing profile. Ignorance of tax law is not a legal defense. And double taxation, where 2 countries both claim the right to tax the same income, is a very real problem that catches thousands of digital nomads off guard every single year. So today, we are building your foundation. This is a beginner-friendly breakdown of how local digital nomad taxes work, what double taxation actually means in practice, and what you can realistically do to stay legal while earning money online from anywhere in the world. Let's start with the most fundamental concept you need to understand before anything else. Tax residency. Tax residency is not the same thing as physical residency, and it is not the same thing as citizenship. Tax residency is a legal determination about which country has the primary right to tax your worldwide income. Most countries have their own rules for determining this, but a very common threshold is the 183-day rule. If you spend more than 183 days in a country within a tax year, that country generally considers you a tax resident. But here is where it gets complicated. Some countries use different thresholds. Some use the concept of a permanent home or center of vital interests. And some countries, most famously the United States, tax based on citizenship regardless of where you actually live or work. That last point deserves its own moment of attention. If you are an American citizen, the United States government expects you to file a federal tax return every single year, no matter where on earth you happen to be living. You might be living in Portugal, paying taxes there, eating pastries, and genuinely thriving, and the IRS still wants to hear from you. This is called citizenship-based taxation, and the United States is one of the very few countries in the world that operates this way. It creates a specific double taxation risk for American nomads that citizens of most other countries simply do not face in the same way. Now let's talk about what double taxation actually looks like in real life. Imagine you are a freelance graphic designer from Germany. You spend 8 months living and working in Thailand. Thailand may consider you a tax resident under its rules. Germany may also still consider you a tax resident if you maintained a home there or have strong ties. Both countries could potentially claim the right to tax your freelance income from those months. Without any protective framework in place, you could theoretically owe taxes in both places on the exact same money. This is the scenario that tax treaties exist to prevent. Tax treaties, also called double taxation agreements, are formal agreements between 2 countries that establish which country gets primary taxing rights in situations of overlap. There are hundreds of these treaties in existence globally. If a treaty exists between your home country and the country where you are working, it can provide significant protection. The critical thing to understand is that treaties do not apply automatically. You often need to actively claim treaty benefits when filing your taxes, and the specific protections vary treaty by treaty. This is exactly why many serious digital nomads eventually work with a tax professional who specializes in international tax law. But let's bring this back to earth for a second, because if you are just starting out, the most practical first step is simply understanding your own home country's rules. Before you worry about the country you are visiting, get crystal clear on what your home country expects from you while you are abroad. Does it tax worldwide income? Does it have exit rules that apply if you establish residency elsewhere? Are there any foreign income exclusions available to you? For American nomads, the foreign earned income exclusion is a well-known provision that can allow you to exclude a significant portion of foreign earned income from U.S. federal tax if you meet certain tests related to your time abroad and your tax home. Understanding whether you qualify and how to properly claim it is essential. Here is another concept that matters enormously for digital nomads, but often gets overlooked: the difference between where you earn income and where that income is sourced. When you work remotely for a client in France while physically sitting in Mexico, which country's tax rules apply to that income? Generally speaking, most countries focus on where the work is physically performed rather than where the client is located. So, in that scenario, Mexico's tax rules would typically be the relevant ones for that particular work. But again, this varies by country and by the specific nature of the work, so assumptions can get you into trouble. Let's talk about some practical strategies that working nomads actually use to manage this complexity. The first and most important is intentional location planning. Rather than just traveling wherever feels right, many experienced nomads strategically track how many days they spend in each country and deliberately stay under the local tax residency threshold, where they do not want to establish tax obligations. This requires keeping genuine records of your travel dates, not just a rough mental estimate. The second strategy is establishing a clear tax home. Having one country where you are unambiguously a tax resident, where you file your returns, where you pay your taxes, gives you a legal foundation that makes everything else cleaner. Some nomads choose to establish residency in countries with favorable tax regimes for remote workers. Several countries around the world have introduced specific digital nomad visa programs in recent years that come with defined tax treatment, making the situation much more predictable than trying to navigate it informally. The third strategy is working with professionals who actually understand nomadic income. A local accountant who has never dealt with international clients may not be the right fit. There are tax professionals and firms that specifically serve location-independent workers, and while they cost money, they can save you far more in penalties, back taxes, and stress than their fees will ever amount to. There is also a psychological trap worth naming directly. Many digital nomads convince themselves that because they are constantly moving, nobody can really find them or tax them. This logic is dangerously flawed. Banking relationships, payment processors, and increasingly coordinated international information sharing between tax authorities mean that the idea of flying completely under the radar is more fiction than reality for most people earning real online income. The goal here is not to scare you away from the nomadic lifestyle. The goal is to help you protect it. Because the nomads who build sustainable long-term careers in this lifestyle are the ones who treat their tax situation with the same professionalism they bring to their actual work. They know their obligations, they plan ahead, they keep records, and they get proper advice when the situation warrants it. You do not have to be a tax expert. You do not need to understand every provision of every treaty between every country you visit. What you need is a clear understanding of your home country obligations, a basic knowledge of when you might be triggering local tax residency somewhere new, and a willingness to ask for professional help before a small confusion becomes a large legal problem. The beach cafe is still waiting. The freedom is still real. But the nomads who keep that freedom long-term are the ones who built it on a solid legal foundation rather than wishful thinking. Start there, and everything else becomes manageable.